Right now, NIO finds itself at a crossroads that could define the next chapter of the EV era. After roaring ahead with monster delivery growth, the stock isn't soaring. It's languishing near the low $5 zone even as the company proves demand is real. Does that mean it's a buy or time to hold tight and watch what happens? In this video, we'll unpack the most important signals shaping NIO's early 2026 outlook. From delivery momentum to technical pressure to catalysts that could flip the script and give you a grounded view of what's likely next. If you want market reality instead of hype, tap subscribe. One click keeps you sharp. Let's ground ourselves with the most recent fact that everyone is talking about. NIO just reported 36,275 vehicle deliveries in November 2025, a 76.3% increase year over year. And that's not a one-brand story. The premium NIO vehicles accounted for 18,393 of those, while the family-oriented Anvo brand delivered 11,794, and the smaller Firefly brand added another 6,088 units. That's real demand across multiple market segments, a strong operational beat that many EV peers would envy. And yet, despite that operational strength, the market has shown caution. NIO shares remain stuck around the $5 range, well below recent highs and far from reflecting the year-over-year delivery boom. Volatility has been the name of the game, not runaway gains, and broader market sentiment toward EV stocks has weighed down even fundamentally strong stories. There's a disconnect here that's worth exploring because it tells you how investors are pricing risk versus reward. What's driving that disconnection? Part of it has to do with short-term price action and technical sentiment. On several recent sessions, NIO's American depository shares have shown pressure with below-average volume on pullbacks, not the kind of aggressive accumulation many breakout stories need. Even with strong delivery data, timid price action suggests investors aren't fully convinced, at least not yet, that the operational momentum will translate into earnings or valuation upgrades quickly. That's not to say the narrative is one-sided. Analysts and financial media still list NIO among EV names to watch as the industry marches forward, especially given long-term growth potential and strategic positioning. But right now, the story is nuanced. Strong fundamentals meeting cautious sentiment and the stock price that reflects the tension between the two. As we think about early 2026, the next big marker on the road is earnings. According to multiple trackers and sources, NIO's next major earnings release for the fourth quarter of 2025 is expected around mid-March 2026, with some calendars suggesting March 18th and others pointing to March 20th. That matters because earnings often give direction in these kind of setups, especially when the market is sitting on delivery strength but waiting for validation in revenue and profitability metrics. That's where something important comes into play: guidance and execution on margin improvement. Delivery numbers are great, they show demand, but investors also want to see how those deliveries convert into top-line growth and cost efficiencies. NIO still runs unprofitable quarterly results, and while narrowing losses or beating consensus matters, the real game changer would be a clear, credible path to profitability. When analysts see a plausible roadmap toward break-even, the valuation context changes dramatically. Another part of the early 2026 picture is how NIO's multi-brand strategy continues to play out. Deliveries from Anvo and Firefly show an expanded addressable market beyond NIO's classic premium segment. That's important because diversified market reach dampens risk. If one segment dips, another might hold up, smoothing out volatility. The strategy is clearly working at the delivery level, but investors want to see that reflected in margins and order momentum, not just unit counts. Let's talk about risks for a moment because they are real and they temper the bull case appropriately. Even with strong November numbers, month-to-month delivery declines from October to November, roughly a 10% drop, raise questions about momentum into year-end and what the trend looks like heading into first quarter. That's not a death knell, but it does mean that delivery strength isn't a straight line, and seasonal or inventory effects could play into the early 2026 narrative. Broader market forces also weigh heavily on NIO's near-term outlook. Rising operating costs, the phase-out of subsidies or trade-in incentives in China, and macroeconomic pressures can all squeeze margins and sentiment. These aren't speculative. They are real headwinds analysts have flagged when discussing why the share price hasn't kept up with delivery growth. This makes timing and execution even more important for investors contemplating a buy or hold stance. Now, if you're watching this from a trader's point of view, there's another dimension to add. Volatility can be your friend or your enemy. News around deliveries, earnings dates, pricing adjustments for new models like the ES8 and strategic moves, all of these can produce sharp swings because NIO is fundamentally tied to growth expectations. That means any surprise, good or bad, can move price quickly in either direction. So for positions built on shorter time frames, careful attention to catalyst timing and level breaks is essential. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. Is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. For longer-term investors, the early 2026 picture is more about trajectory than noise. NIO's operational strength, diversified brand mix and unit growth indicate a company that is building fundamental scale. What remains to be seen and what early 2026 will help clarify is whether this scale begins to translate into consistent profitability and valuation expansion. If that begins to show in earnings and guidance, this could be a period where long-term holders feel rewarded. If it doesn't, patience will be tested. Putting all of this together, the early 2026 forecast for NIO isn't a simple buy or sell. It's a conditional moment where strong delivery data exists alongside a cautious market pricing framework. What you want to see in the coming weeks is that deliveries hold up, margins show improvement, and earnings guidance reflects confidence rather than uncertainty. That alignment would shift the narrative toward the buy case. If those elements falter, the hold stance becomes more rational as the market prices in risk before award. NIO's story continues to be one of contracts, operational power on one side, reservation in price action on the other. That tension is exactly what makes early 2026 a defining phase for this stock, not just another quarter. If you're watching how this unfolds, use these signals as your compass. Delivery strength, earnings execution, brand diversification, cost visibility, because they will show you whether the recovery converts into valuation upside or merely treadmills at sideways levels. At the end of the day, the question isn't just is it a buy or hold, it's under what conditions does one make more sense than the other. Once earnings prints and delivery trends start filling in those blanks, you'll see the answer in the price and the narrative together. This is it for this video, guys. Thanks for watching and please make sure to subscribe, like and leave a comment down below.